Let's start macro, big picture on the commodity side. Rebecca, why oil prices cannot find a bid and what anybody can do to stem this tide to the downside?
So it's a great question, Dom. And if you remember, we did this exact interview almost a year ago on this exact topic when crude was kind of in free fall at the end of the year. We've got a couple factors in play that seem to always happen at the end of the year. We're in a seasonally weaker time for crude oil demand. We typically see inventory builds. We are seeing larger than expected inventory builds right now, but that has really sparked the momentum to the downside. We are no longer in a deficit. We're not drawing crude oil like we were in the summer. We're building inventories. We have the second factor, which you just noted. China does not have any more export quotas available. So they're not going to buy this kind of excess crude that they have been throughout the year and exporting out products. That's another kind of headwind. And lastly, and I think this is kind of the key point, we have a lot less faith in what OPEC has done and is able to do in the future. As they've cut, it's become harder and harder to get everyone in line. The cuts are no longer quotas, they're voluntary. There has been some lack of compliance. So the market has started to question the OPEC put that has been the support underneath previous sell-offs. And when you question that, it really, really inspires the momentum traders and the CTAs to press their shorts. And guess what? The traditional hedge fund players, they've taken a knee for the year. They're winding down the clock. They're not necessarily putting on big bets, so there's not a lot of friction to the downside.
Peter, this is interesting. Rebecca mentions those commodity trading advisors, other hedge fund type, players who are basically saying that, we'll take the losses right now. We'll kind of sit on the sidelines here. What exactly has that meant for energy stocks? Falling oil prices are a tailwind for certain sectors, but energy companies have been feeling the pinch, though not so much Exxon and Chevron.
Well, for sure, this is going to hurt cash flow. And even on the upside, oil stocks did not keep up with the commodity. There's always been a certain amount of skepticism in equity markets, around the oil price when they were good. But, point to the story just before this about Chevron increasing CapEx. Now, some of that increase is due to an acquisition again in the U.S. ExxonMobil has been, increasing their investments in the U.S. And they announced yesterday that their Permian production is going to be up 8%. Now, keep in mind that Exxon's overall volumes in the U.S. have been declining for 5 straight quarters. And you've got these bigger, better capitalized companies who control U.S. oil production. And that's very different than when OPEC Plus put this group together with this declaration of cooperation 7 years ago. It's just going to be tougher to slow down U.S. production, which has continued to be found a lot of watchers as to why it continues to grow, despite drilling activity being lower. And the story here is about efficiency. So that's, that backdrop is adding to, more pressure on oil at a tough time of year to be a bull.
Peter, a lot of focus has been on the Permian Basin out in West Texas. This idea that they're trying to consolidate. You're getting a lot more activity, M&A activity to focus on certain key oil producing and gas producing regions in the country. How much consolidation, or can consolidation happen enough to where U.S. producers, shale oil producers, can actually bring down their break-even costs to a level that won't be as affected by some of the OPEC plus policies that are out there? I guess that's the key concern for U.S. producers.
Well, it's certainly a lot lower than what we're seeing today, in the mid 70s on Brent and around 70 on WTI. I mean, the budgets that like Exxon and Chevron are running are on $60 Brent. And frankly, these things work, these plays for most of these companies well, down into the 30s. It's an industry that has continued to get increasingly efficient over time, and those efficiencies accelerate during downturns. Now, activity overall has been down, but production, has continued to grow, not at the same pace that we saw like a decade ago as the Permian became kind of the new thing. But it's a lot more durable, I think, than OPEC gives it credit for.
Rebecca, we're going to give the last word to you here. The oil price decline has been something that perhaps is obviously not good for any oil producer out there, specifically places like Saudi Arabia and Russia and other large ones. The U.S. is included in that picture. We're the biggest producer out there. How exactly then does policy from OPEC look in the coming months, given the fact that maybe there's a philosophy that maybe lower oil prices could benefit some of these bigger producing regions if it hurts U.S. shale producers?
So I don't think that's going to be in their calculus. I think what you're alluding to is, will they go for kind of the market share war as opposed to price stability? And I think we've all learned the hard way that nobody wins there, including the Middle East. The Middle East is now highly focused on creating themselves, or OPEC is focused on being the Fed of oil markets, not necessarily the instigator of mass volatility. So I don't think that strategy is what they're going to do. What I think they're going to do is play the long game here. They know that shale production cannot grow at this rate indefinitely. In fact, this year, U.S. crude production is only set to grow 400,000 to 500,000 barrels a day. That's down from the million that we did this year. Could there be continued efficiency gains there? There can, but not to that extent. So I think what they're going to do is they're going to stay with their strategy, and they're going to be the last man standing when U.S. shale production does start to really compress and flatline.